This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We've gone through and had a look at everything to do so far, haven't we, with how to determine your functional currency. We've also gone through and looked at how to translate overseas transactions into the functional currency and how to deal with exchange gains and losses. Now what we're going to go through and do is we're going to look at having a parent company and a subsidiary and how to consolidate that subsidiary, and the issue being that that subsidiary has a currency that is different to the currency that the group prepares its financial statements within. Okay, so what we have there is when we look at the group accounts are prepared in what is referred to as the presentational currency, or sometimes just the presentation currency. So imagine you have a parent that's in dollars. They will probably say that the group currency that the group accounts are prepared in or presented in is the dollar. It's not going to be so complicated that, that you have a parent company that is, say, in euros. The group financial statements are prepared in dollars, so you need to translate the parent as well. No, you're just going to have a parent whose currency is the dollar, and therefore the group presentation currency will be the dollar, and you have a subsidiary at the bottom, and the subsidiary's functional currency is different to the group's presentation currency. So the issue there is that when you consolidate the parent and the subsidiary, you can't just go through there and add the parent and the subsidiary together on a line by line basis, because that's not right, is it? Yeah, you can't just add dollars to euros. You need to translate the overseas subsidiaries results, don't we, before we can go through then and consolidate. Okay. So what have we got here? Well, if you think about it from the group statement of financial position perspective, what you go through and do there is you translate all of the assets and the liabilities at the closing rate. Please don't start thinking about anything to do with monetary and non-monetary. No, you have a subsidiary. All of the assets, all of the liabilities are denominated in a different currency to the group presentation currency, so you need to translate all of them, and you translate all of them at the closing rate. Nice and straightforward. What we then need to go through and do is investigate the workings ever so slightly, because when you look at the net assets working of the subsidiary, so is that the working number 2? That needs to be done in the overseas currency, because the subsidiary is an overseas asset, so let's work it in the overseas currency first. Then we go through and think about goodwill. Again, goodwill is an asset of the subsidiary, isn't it? So it only seems right there that when you're thinking about working number 3, that you work it out first of all in the overseas currency. But then what you need to go through and do is at the end of each year, you need to consolidate it. So you need to convert it into the group presentation currency. So you need to calculate it in the overseas currency, and then you go through there and translate it at the closing rate. Similarly, non-controlling interest, so is that there as working number 4. Again, you work it based in the overseas currency, but again, once you've worked it in the overseas currency, you need to consolidate it. So in order to consolidate it in the presentation currency of the group, you need to translate it at the closing rate. So anything to do with the sub on the SFP, you calculate it in the overseas currency and then you translate it at the closing rate. Just be careful, this is the one that I draw your attention to, and the one that you need to pay close attention to in the exam is working number 5. What's working number 5? Yeah, group retained earnings, isn't it? Well done, excellent. Group retained earnings, so that's what the parent owns of the subsidiary, isn't it? And if we're looking at the parent is concerned with the presentation currency, isn't it? So in the group retained earnings, we record everything in the presentation currency. So just be careful, you put in 100% of the parent's retained earnings in the presentation currency. But be careful, when you take your share of S's post-acquisition, we need to translate that at the closing rate before we take our share. So when you take the post-acquisition profits from working 2, You need to translate them at the closing rate before you then take our share. There is then an important and we will touch upon it afterwards. The investment that you have within the subsidiary that's contained within the parent's books. So that investment line, when the parent will have bought it, it will have translated it that was at the rate in place on that date. That investment is a non-monetary item, isn't it? So you do not retranslate it. However, if we're going to eliminate that investment against all the assets and liabilities which have now been translated, don't forget, at the closing rate, then to eliminate like with like, we are within the group account going to retranslate that investment at the closing rate, and therefore there will be a gain or loss on translation of P's investment in that subsidiary. Okay, so we'll deal with that when we get to the example afterwards, but just bear in mind there's an extra little step to consider. I would say that is new. All the other bits, that's not really new, is it? It's just logic, isn't it? Translates everything at the closing rate once you've calculated it in the overseas currency. All right, technically it's new, but it's nothing that you haven't done before. You know, you're working 2 is the same, working 3 is the same, working 4 is the same. It's just done in a different currency. Okay, so that's the group SFP. I can hear you calling, what about the group statement of profit or loss? Well, when we go through there and think about the group statement of profit or loss, and is it there other comprehensive income, as it slowly scrolls up, it's not very exciting. What you have there is all your income, all your expenses, all your gains, all your losses of that subsidiary are all translated at the average rate. Now, technically speaking, it should be at the historic rate, but if it's not a currency that fluctuates regularly during the year and it's a fairly stable currency that the subsidiary prepares its accounts in, then what we can do is we can just take an average rate, because if it wasn't a stable currency, we'd have to translate everything at the historic rate, so the rate that each transaction took place on what particular date. Ooh, that would be a nightmare, wouldn't it? Imagine you've got millions of different transactions within your overseas subsidiary and having to find the exchange rate for every single day. Not in our exam, and very rarely done in the real world. Okay, so what you have there is everything to do with the overseas subsidiary in profit or loss and OCI, gains, losses, income, expenses, everything there at the average rate. Okay, excellent. Let's go through then and have a look at an example about how we consolidate an overseas subsidiary. Like many of the questions that we've done so far throughout the videos, it's not exam standard, but it is very much exam style. Okay, again, what we're doing is we're going to focus on the group aspect, and we're just going to go through and ignore the, if you like, individual accounting standards aspects. As we work through the accounting standards later in the videos, then we'll start to bring those into the groups questions that you can then start to attempt in your own time at home. Okay, that the focus at this moment in time is entirely on the groups aspect. So here, if we go through and have a look at the example, just be aware it does ask for the consolidated statement of profit or loss, also the consolidated statement of financial position, both of them there at the same date, December 2015. The only thing that I would mention here, it is exam style, but maybe not so much this time, in that I've never seen any questions at P2, and I think it's unlikely to be the case as well, whereby you see a group statement of profit or loss and a group statement of financial position being required within the question. I think if you examine both, it just takes away the opportunity for the examiner to start examining more of the accounting standards, and there therefore then is a bit too much focus, if you like, on the group work. Okay, so here we're looking at both, but it's unlikely that you would see that within the real exam. In the real exam, you would either consolidate a foreign subsidiary in an SFP question, or you would consolidate a foreign subsidiary in a statement of profit or loss question. It would be one or the other. So as always, we say it's exam style in this instance because you can see that at the bottom, the first thing that you have in the additional information is the background information with regards to the group structure. So what you've got there, it says on the 1st of January is it there 2015, so that's the start of the year. Holly went through there and acquired, was it 80% of the share capital of Ivy? So Holly must be the parent, Ivy is therefore the subsidiary, for a consideration of 760 million dinars. So you can see there that we have paid dinars to acquire this subsidiary. And you've got there, haven't you, if you look at Holly's books on the SFP, Holly is the parent, Ivy is the sub. You can see that the investment in Ivy is there as $200 million. Okay, so what you have there is Ivy's functional currency is the dinar, Holly's functional currency is the dollar. The likelihood is that the group account will be prepared in the dollar as well. Okay. So we need to go through there, don't we, if we focus on the statement of financial position for now. When we consolidate that subsidiary, we need to go through, don't we? And we have to translate all the assets and all the liabilities at the closing rate. We need to look at the workings, and when we're looking at the workings in relation to the sub, so working 2, the net assets, working 3, goodwill, and working 4, the non-controlling interest, we need to work that in the overseas currency, which is the dinar, and then we need to translate it, don't we? Okay. Whilst we're there, that investment is of 760 million dinar. Well, you can see there that Holly has recorded that correctly, because you've got there, is it 760 million dinar. The historic rate is the rate at the 1st of January, which is the 3.8. So if you divide the 760 by the 3.8, that gives you there, is it the $200 million. Okay, so Holly has correctly recorded that investment within its financial statements, and it has not gone through then and retranslated it, because remember, an overseas investment is a non-monetary item, so you translate it and leave it. Okay, there we go. So what we're going to go through and do, you can read the rest, if you like, of the information. It's bog standard. It tells you the retained earnings, it tells you the fair value of the net assets and all the stuff that we've seen before. It says any difference in the fair value and the book value is to do to non-depreciable land, so there is a fair value adjustment. The non-controlling interest is valued using the proportionate share of net assets method. Okay, and then at the bottom you have, is it the exchange rates. So let's go through, start things up. Grab yourselves a separate page of paper. We'll look at the statement of financial position first, and then we will focus on profit or loss. And when we're looking at the position statement, we're going to focus on the workings. Again, we'll ignore working number 1. We'll start off with working number 2, the net assets. And remember, the net assets of the sub, we calculate in the overseas currency. So you have that there, is it at the reporting date? Is it there at the acquisition date? And then the post-acquisition period. Okay. Again, remember, the information all about S and its net assets comes from the SFP at the reporting date. So is that 350 and 280? So 350, 280 is that share capital, retained earnings, and as always, the share capital at the reporting date is then the same, isn't it, as what we have at the date of acquisition. Okay, excellent. Nothing too difficult there. We need to find the retained earnings at the date of acquisition. We're told that they are 150 million. So we can put in the retained earnings at acquisition as 150 million. Remember, that little adjustment to work out the fair value is whereby we take the fair value of the net assets at 600 million. So we know that column at acquisition needs to total 600 million, isn't it? It doesn't. If you add it up, I think it comes, is it 5? It comes to 500, doesn't it? So that is your fair value adjustment, and that's your fair value adjustment here for land, which is a bonus because that is not depreciated. So it's 100 at acquisition. We're not told anything else about it changing, so we assume that it is the same at the reporting date. So that gives me there, is it net assets at the reporting date of 7:30. The post-acquisition movement between the two is there as 130, isn't it? Okay, and that's entirely due to the retained earnings. There's no movement in your other component of equity. Once we've done working 2, we can then go through and play around, is it with working number 3? Because remember, when we've got working 3, again, that's your goodwill. The goodwill is in the overseas currency, isn't it? We calculate it in the functional currency of the subsidiary, and then we retranslate it at the closing rates. So we have there, is it the fair value of the consideration? If memory serves me right, that's 760 million dinars. That's where you've got to be very, very careful, because a lot of people will just go through and take that figure right from the very top. Yeah, that $200 million. No, the figure that you're using here is the figure in the functional currency, isn't it, of the sub. So 760 million. We then add on the non-controlling interest at acquisition, don't we? Well, here it's based on the proportionate share of net assets. So we're told the fair value of the net assets. I've also got it in working 2, haven't I? Which is there as 600. 20% of 600 is 120. And then we deduct, don't we, working 2 at the date of acquisition. So we deduct, is it 600? If I total that up, 760 plus 120 less 600 gives me there, is it 280 million dinars. So we then need to translate that at the closing rate. The closing rate given within the question is there, is it as 4.3. So I translate it at the 4.3. So 280 divided by 4.3 gives me there, is that $65.1 million. That's the figure that I would show on my statement of financial position. Okay, so 280 divided by 4.3, 65.1. Okay, excellent. Working number 4 looks at the non-controlling interest. Again, that's what the non-controlling interest own, isn't it, of the subsidiary. So again, they own the subsidiary, which is denominated in the functional currency of the sub. So we work out the NCI in the functional currency of the sub. So we look, don't we, at the date of acquisition, which is the same, is it, as what we saw in working 3. So that's the 120 million. To which we then add on the non-controlling interest share, is it 20% of the post-acquisition profits from working number 2. Again, if you're unsure, let's just go back and check. There we have it. You can see there, can't we? You've got 130 as the post-acquisition movement in the net assets. So is that there as 26? Adding those two together, does that give you 146? Again, we need to look at that at the closing rate, which is there as 4.3. So that gives me there, is it $34.0 million when I round it to one decimal place. Okay, I think 33.95. So that rounds up to 34. Okay, excellent. Everybody happy with that? Again, the 20%, we own 80, so the NCI own 20. All good. Excellent. What we've then got, if we move on, is it the working number 5. This is where you need to switch on group retained earnings. So it's looking at what the parent shareholders own within the group. So the parent shareholders essentially own the parent, don't they? And the parent is denominated in dollars. So the group retained earnings is in millions of dollars, the presentation currency of the group. So we go through there, don't we, and look at, is it 100% of the parents? So 100% of the parents' retained earnings is 110. So we can put that in as 110. We then add 80% of the post-acquisition profits from working two. But remember, the 130 is in dinar, so you need to translate that, don't we, at the closing rate. Everything on the SFP is done at the closing rate. So that gives me there, is it 24.2? Okay. Excellent. Everybody happy so far? Sure, positive. Excellent. The next bit, it is the funky, tricky little bit, but you've just got to be careful. So what we're going to go through and do there is we're going to do a separate working. So we'll call it working number 6. So separate page, or carrying on from where you left off. It's not a big working, but what we've got there is either the gain or loss on the investment. Because what's happened, if we think about it, is if we go back and look at the financial statements, the $200 million right at the very top there, when Holly purchased the shares in Ivy, it recorded it at the historic rate, and then they did not retranslate it because it's a non-monetary item. Okay, so in the individual accounts of Holly, everything's been done fine. But the issue that we have is that we're looking at the group accounts, aren't we? And when we look at the group accounts, we're going to replace that investment with the assets and liabilities of the subsidiary. But when we've replaced the assets and liabilities of the subsidiary, we've included them, haven't we? Or we will do when we prepare the group SFP at the closing rate. So all of those overseas assets and liabilities have been translated at the closing rate, and we need to eliminate that against the investment, don't we? We remove the investment and replace it with all the assets and liabilities. The issue that we have there is that when we remove the investment is recorded at the historic rate, isn't it? Okay, it's no longer, if you like, recorded at the most up-to-date value, being the closing rate. So we need to get it to its up-to-date value. And when we record it at its up-to-date value, looking at it from a group accounts perspective, i.e. at the closing rate, there then may be a gain or loss when we eliminate that investment. So what we've got is that the investment was, if you like, in terms of our dollars, it was at $200 million, wasn't it? That was based on our 760 divided by the 3.8. Whereby now, when we want to eliminate it, we want to eliminate it at the 760 divided by, is it the 4.3? Okay, so 760 divided by 4.3, that gives me there, is it 176.7? Okay. So the investment was at $200 million. It's now at 176.7. So you have a reduction in your investment. If there is a reduction in an asset, then that is a loss. And that loss is there at 23.3. Okay, it's a shortcut. It's a bit of a cheat. There's a much longer winded method of working everything out within the group retained earnings that you may see within the study text of your chosen tuition providers. But for now, this is all that you need to do. Okay, you work out the gain or loss on investment. It's an additional step beyond what we've seen previously. So here we deduct working 6's loss of, is it 23.3? So what we have there is our group retained earnings are there, is it at 110.9. Okay, excellent. Everybody happy there? So the key bit that you've got to do, I'd learn the, if you like, additional standard working for your groups and overseas subsidiaries. So you look at what the investment was. It was 200 originally, And if you now retranslate it, so you're comparing, aren't we, what it was based on the historic rate compared to now what it is under the closing rate. Okay, so you have a reduction in the investment, so you therefore have a loss of 23.3. Okay, excellent. What we can do now is we're in a good position to go through and look at the group statement of financial position. So what have we got? Let's look at the top half, which is the non-current assets. So you've got 200 and 500. So just be very careful. It's 200 plus 500. But don't forget as well that there was a fair value adjustment of 100 that you need to record, don't we, within the subsidiaries non-current assets. Again, don't forget everything in the sub needs to be translated at the closing rate. So if you total that on your calculator, you should get 339, is it 0.5. Okay. Again, the key bit that most people forget is that fair value adjustment. If you can't remember it, always double check, go back to the working number 2, see what adjustments that you make, and make that necessary adjustment there. Okay, so here, that fair value of the land, it's there at 100, and I have translated it because it is there in dinars. Okay. Then what we've got, remember, is your goodwill. So I can look there at my goodwill. Is that there as working number 3? Working number 3 on my goodwill, what have we got, is $65.1 million. So I can throw that in, $65.1 million. And then I have, is it my current assets? Current assets, 90 and 390. Just don't forget that with the 390, that needs to be translated at the closing rate. That should give me, is it 180.7. Totaling that up gives me 585.3. Okay. Hopefully it will balance. If it doesn't matter. In the exam, when you do a group SFP with an overseas subsidiary, it does very rarely balance because there's so much going on in terms of the translations, rounding differences. You could have everything right, and you've got a rounding difference, which means that it doesn't balance. So don't stress, don't panic within the exam. So we've got there your equity share capital. 100% of the parent is that there's 250. So we can throw that in there at 250. We've then got, is it our group retained earnings, which is there, is it as working number 5. So if we can cast our minds back there, there's working 6, there's working 5. Is it 110.9? We've then got, is it the non-controlling interest, which was there, was it as working number 4? That was $34 million. We've then got, I think, some non-current liabilities, which we can look back to the financial statement. So 80 and 65. Again, don't forget to translate the 65 at the closing rate. So that gives me, is it 95.1. And then your current liabilities, what have we got? 50 and 195. So I take 50 and 195. Does that give me 95.3? It's the moment of truth, the bit where you panic and you think, oh no, stress, have I got it right? Don't do that in the exam. Just plow on. If it balances, great. If it doesn't, it doesn't. 585.3. I can't even remember what the assets were. Magic. Okay. Beginner's luck, shall we call it. You have the assets at the top of 585.3. And is it the equity and liabilities at the bottom of 585.3? If it does balance within the exam, feel free in the exam to let out a shriek of joy and just put everybody else off in the exam hall. Okay, oh, that person over there has got their overseas subsidiary SFP groups question to balance. Wow, okay, that's a clever individual. Even if it doesn't balance, just shout a shriek of joy anyway. May as well. Okay. So joking aside, everybody happy there with the SFP? Okay. Again, I think the key bits to go through and take on board are looking at that new bit there in terms of the gain or loss on the investment, looking at what it was at the historic rate compared to what it is now. And then just remember that working 2, working 3, working 4 are all in the overseas currency, and some translation needs to take place, doesn't it? Okay. Before I forget, because I've done it several times before, don't forget to do the group statement of profit or loss. Okay. So what you've got there, I'm going to do it in detail, just in case it was to crop up within the real exam. So what you've got there is you have your revenue. So we've got P, we've got S. So we put S in the overseas currency. Then what you can do is you can put your rate. So remember, everything there is at the average rate. And then what you can do there is S, isn't it? And that's when you have S in dollars. Okay, so when you're adding across, it will be 100% of P and 100% of that column of S. If you wanted, and I don't think there are any, you could also have your adjustments column. Wow, that would be harsh, wouldn't it? And then you would have, is it your group? Okay. So what have we got? If we just go back, look at the various bits and pieces of information that are useful. You've got the average rate there, haven't we? Which is 4. And then we can go through there, can't we? And begin to look at the statement of profit or loss. Again, I've kept it very, very, very simple. I haven't put in any complex adjustments. There's no PUP adjustments. There's no intracompany sales. There's nothing going on at all. We're just looking at the basics. Okay. So Holly, 2471664. So 2471664 at a rate of 4. So 1664 divided by 4 gives me 416. If you add them together, that gives you 663. Okay, excellent. We've then got, is it your cost of sales? So 181 and 1288. So 181, 1288 at a rate of 4. Gives me there, is it 503? I think that's a mistake. Yeah, that's fine, 503. Careful. Getting ahead of myself. That's 322 for S. There we go. And then it's 503. Excellent. Trying to move through it too quickly. Should give you gross profit, is that there, of 160. I've then got my expenses, 29 and 156. So 29 and 156 there on my expenses. 156 divided by 4 is 39. 39 plus 29 is there is 68. We've then got our finance costs, 8 and 40. Even I can do 40 at 4 without a calculator. That's 10. And even I can do 10 and 8, which is 18. Well done, Chris. There we go. Maths is getting better. That then gives you PBT. Again, you don't really need to put it in, but we will. PBT is there as 74 before you then go through and get your tax figure. Tax figure 5 and 36. I can remember my 4 times table, and 4 and 9 to 36, and 9 and 5 is there as 14. Gives me my group profit for the year. Is that there? Oh, careful. As 60. Okay, $60 million. What we've then got is we can total up, is it S's column, because we need to go through there, don't we, and split the group profit for the year into the amounts attributable to the parent and attributable to the non-controlling interest, don't we? So if we go through there and total up S's column, what have we got? 416 less 322 less 39 less 10 less 9 gives me 36. The non-controlling interest owed 20%. So 20% of 36 is that 7.2. 60 less the 7.2 is it as 52.8, isn't it? The amount attributable to the parent is there as a balancing figure. Okay, excellent. You might think that's just a little bit of overkill, isn't it? Going through there and putting in all of those separate columns. So a little bit much, putting it in the overseas currency, putting in the rate, and then adjusting it to go through and get S's in the presentation currency of the group. But I think it's very important to do, because the way in which it gets complicated is that S was there in dinars, wasn't it? There's nothing to say that S enters into foreign currency transactions of its own in another currency. So I'm not saying it enters into transactions in dollars. It could enter into transactions in any other currency. And what S will need to do there is it will need to get its books correct first. So before we do any consolidation, it will need to go through there and look at the individual company aspect first by retranslating any monetary items at the closing rates, and then getting any gains and losses on those monetary items. And what you have there is that the gain or loss on the monetary item will be in dinars, won't it? And you've got to be careful, because if you put that in without any further translation into the group accounts, you get it wrong, because the dinars need to be translated into dollars. So what you would go through and do there is the important column is this one, isn't it? Okay, here. Yeah, you need to put everything in there first in S's column in dinars and then translate it. So if there are any foreign currency differences in S, or maybe if there is an impairment in S, they're all things that arise in dinars that then need to be translated into dollars. So do just be aware. It does get a little bit more complicated as you move forward, because it examines not just group accounts with an overseas subsidiary, but it will examine the individual functional currency aspect as well. And then on top of that, there might be some accounting standards furthermore to deal with that don't actually involve foreign currency. You'll be glad to know. But it does get quite complex. It does get quite tricky. There's one little bit that we just need to go through and complete, and we'll go through there and we'll look at that within the next session.